Hey folks, Dan Frio here with the closing bell for August 7th, 2024. What happened again today? We had the stock market open up and then it closed down. We had interest rates open down and they ended up. What in the world is going on? Well, that's what we're going to talk about in today's video, because at noon today, there was a big auction, a Treasury auction. The Treasury issued $42 billion, $42 billion in debt. Okay, investors are just getting inundated with all this debt and they just can't buy it all. So it pushed up yields a little bit. Bet you didn't know that, and that was the reversal in the markets this afternoon. Another piece of the puzzle was consumer debt. Remember, we heard, we've been hearing for months, consumer debt is out of control. It almost hit $20 billion back in January. Where is it today? Those are what we're going to talk about in today's video, and that's what caused the market reversal. So what you're seeing on the screen right now, these are the top 6 programs people use when they're buying their first house. I did have a comment yesterday when I said, I think these rates are wrong. I didn't see a move in the MBS market, so how did rates go up so high? Well, Matt Graham from MBS Live, he actually reached out to me today and said, Dan, you must have missed the MBSs because the rates are accurate. Okay, so my apologies to Mortgage News Daily and Matt for my misinformation yesterday and in this morning. But Matt also came up with an article he sent me over earlier today, talking about the spreads between mortgage rates and the 10-year Treasury. I'm going to put this link down below so you can actually take a deep dive from the master himself, Matt Graham, who's the CEO and founder of MBS Live. So thanks, Matt, for all that you do for us, because I couldn't do this channel without you. So let's get over to what happened today. The first thing happened is right through here, the 10-year Treasury auction. There was $42 billion issued today. And you guys know how I feel about that. The government is way spending too much, and they're dumping all this onto the investors in Wall Street, and Wall Street's not gobbling it up anymore, so they're pushing up yields. That's what happened around noon today. Another piece of the puzzle that came is consumer credit. Remember, people kept saying consumers are just getting engulfed in too much debt, and all these interest rate rises are just going to put us into a recession or maybe even a depression. Well, got some good news on that front today. If you go over to this tells us where consumer debt was and where it is today. So back in January, we had about $20 billion in consumer debt. What is it today? 8.9. So it was cut, basically in half. Okay, but you're not seeing this on mainstream media and a lot of other places because it's not juicy content, because it's actually saying the economy's not so bad. Okay, so the next thing I want you to show you guys is there's an interview with a real estate analyst, and he's going to talk about housing, builders, interest rates, and spreads. So this is a fantastic interview to watch, and then when we're done, I'm going to kind of put everything together for you for the end of the day's closing bell, and we'll be right back. So let's listen to the interview.
We heard off the top, Jamie Dimon in short saying he doesn't think that the Fed's rate hikes matter much on a grander scale, but they certainly impact housing. The homebuilder stocks are trading lower today, adding to their declines over the past week. For more on his take on the housing sector, let's bring in Stephen Kim. He's Senior Managing Director of Home Building Equity Research at Evercore ISI. Stephen, it was not a pretty period for the homebuilders. It turns out they hate lower interest rates.
Well, they've actually moved up quite nicely over the last few months here, actually the last month or so. So we actually have had a very nice positive reaction to the lower rates. Frankly, though, I would think that we have a lot more to come, because right now what we're seeing on the ground is that in 2Q earnings, we're hearing that June really wasn't a great month. July probably wasn't that great either, based on our contacts. And so this move down that we've seen here over the last few weeks in the 10-year yield, which will of course translate to the mortgage rate, is going to be very beneficial, we think, for the housing market. And we think things are going to get better on the ground as we get into the third quarter.
They could get better overall, but could they get worse? Look, the builders have benefited so much from short supply, being able to buy down rates, low inventory, relatively affordable home prices. The premium, I think you've pointed this out, they used to command is pretty much gone. Does all of that reverse or start to reverse now?
Well, I think not. I think that what we have here is we're probably going to see another step up in demand as the rates come down, but the supply remains extremely tight. It's moved up a little bit. I think people are trying to make a mountain out of a molehill. They're looking at maybe a couple of markets around the country where things have gotten a little bit worse, but it really hasn't metastasized to the rest of the country at all. As a nation, we have 3.8 months of supply of resale homes on the market. That used to be normally around 5 to 6 months. it got as low as, 3 months or so. But at 3.8 months, we're going to still see a very tight market. You're not going to see a lot of pressure on home prices. And with demand improving, with the rates coming down, we think third quarter is looking to be a pretty good period.
What would a half-point interest rate cut in September and maybe a further cut or two for the remainder of the year mean for the housing business?
Well, I think it's important to recognize that the mortgage rate really cues off at the 10-year yield. And that's
He's going to give the lesson that I give you guys every day. He's going to talk about how the Federal Reserve doesn't control mortgage rates. It's controlled by the bond market. So this is a really interesting piece of the puzzle.
because people usually stay in their homes for, 7 to 10 years or so. As a result, the 10-year yield is really what matters. And the 10-year yield obviously anticipates a lot of the Fed cuts. So the Fed cut per se probably won't impact the mortgage rate when it actually comes. This period we're in now, as people are thinking the Fed's going to cut, that impacts the rate. So you kind of get that. However, I will say that a lot of people who buy houses for the first time may not be very sophisticated. And as a result, they may not really know that the long end of the yield curve is what matters. So when they hear that, oh, the Fed is actually cutting rates now, that may actually drive more traffic to the doors of the home builders. That's something to watch out for. We are seeing that there's a lot of psychological barriers to the buyers right now. People think it's all math, but I've said many times, it's not just math, it's mental when you're talking about home buyer demand, particularly first-time buyers. So the Fed actually cutting rates may not change the mortgage rate that much, but it might get people off their couch and into the doors of the home builders.
Wow. Couldn't have said it any better myself. That's why you guys out there know a little bit more about mortgages and buying your first house than most people out there, because they're going to see Federal Reserve's cutting rates, so rates are going to come down. And I get that question asked every day. So mortgage rates are tied to the mortgage bonds, and what we're seeing on the screen right through here is the mortgage bond. So when Matt called me earlier today, right through here, again, Matt Graham, when reached out to me today, he said, you need to go to the MBS 5.5. I was using the 6% range. So I do want to change this over for you. So we're going to start tracking the MBS 5.5 so you guys get a little bit better read on what's going on in the market. Let's get to a one-day chart. We have MBS's down right now 4 ticks. What does that mean, basically? What you're seeing on the screen right now is the price of a mortgage bond. Okay, the only thing you really need to understand is if the price of the bond's going down, that means rates are going to go up. Okay, if the price of the bond goes up, that means rates are going to come down. There's an inverse or a yin-yang effect with this. So that's what we're seeing right through here. And that's why yesterday I missed it. I didn't see that the move in the MBSs. So that's why I didn't think the MBS live rates were accurate, but they were dead on the money. So that's what we're talking about today. So if you're out there, well, let's just go over to rates. Here's where rates finished for the day. So the 30-year fix was up 6 basis points to 6.58. And then you have the government-backed loans right down through here, FHA and VA. If you're wondering what USDA rates are going to be, well, they're probably going to be right in the range of where you are through here. But what comprises of these rates? Well, there's basically 5 components of it. One of the 5, or let's go through the 5 for you. One is this person is buying a single family home. The number 2 is they're buying it that's going to be their primary home, meaning they're going to live in there. Number 3 is they're a first-time home buyer. Okay, there's 2 more criteria with this. So let's get over to this and let's check what the survey says. The survey says right through here, this is at a 75% loan to value with a 780 credit score. That means these people are putting down 25% and they have a 780 credit score. So if that's not you, so you're like, well, Dan, that's not me, what kind of rate or what kind of program can I fit into? Well, just give the hard lifting to us. So don't go out there and apply for 50 different loans out there, not even knowing what you're getting into. Reach out to us. Why? I'm going to give you multiple reasons. One, we're ServBank. ServBank because we're one of the country's largest mortgage servicers. And you might be, Dan, who cares? Well, we're big, and we have the economy of scale to help you guys out. Also, the thing behind this is we're also one of the country's largest brokers. So what does that mean for you? Well, that means that we're set up with about 50 different lenders right now. Okay, so by applying with us, there's going to be one credit pool, one application, and we're going to give you products and quotes from all 50 companies. So we're not going to give you all 50. We're going to basically break it down and say, okay, here's the best one out there. And that's what we're going to do for you. So make us do all the heavy lifting for you guys, because if you're looking to buy your first house, you got a lot of other things to worry about right now other than the financing. So put that on us. How do you find us? Well, just go to therateupdate.com and here we are. This is my website. So if you want to apply for a loan, click there. But I'm going to ask you a question first. Are you looking to buy your first house? If you're looking to buy and you're just tight on the funds, see if there's a grant up there that you might qualify for. So you're going to find grants up there that go up to about $7,500. And the reason why we post them up there is they're the best programs out there in the market right now. If you are in the Chicagoland area and you're looking to buy your first house, we do have $10,000 grants for down payment assistance and helping you with closing costs. So if you're in the Chicagoland area, shoot me an email. I'd love to talk to you and discuss if you're eligible for one of those programs. How do you do that? Well, you can click the Apply Now button, or you can just scroll to the bottom of our website, and our information is right there. We got an 800 number, which is 844-775-5626, or you can email me at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic evening. I'll see you back here tomorrow morning. Bye-bye.